Okay, let's shift to the VC side of the world. Michelle, this is where you shine. This is your section. Michelle, you spent 8 years at BDC. You still have 2 major funds there. You left in July. Since you left, BDC has written down their portfolio by $220 million, which is a significant write-down. And I made the argument that all of venture capital in Canada is dependent on BDC. But BDC itself is struggling. What am I missing, and what's going on the inside of BDC? Or I suppose you can take that question any way you want if you don't really want to answer that.
Not sure I'm going to answer that part.
Spill the beans.
Yeah, exactly.
Well, first of all, I think if you look across the VC landscape, you'll see pretty much everybody writing down, unless they're messing with their numbers a little bit. The venture capital ecosystem has not performed well. I mean, Derek alluded to this. Well, you didn't allude to it. You said it outright in your blog, in your post. But the venture capital marketplace has not done well from a returns perspective for a long time. There are blips on the radar. You see Cohere go. You saw Xanadu, if anybody knows about the Xanadu story, doing a SPAC on the NASDAQ. This was like a month ago. So there are blips on the radar where we've got some companies in Canada that are doing very, very well. But overall returns are sitting at around 1.1, 1.2 times MOIC. That's not great.
And do you want to explain MOIC before
So
we
just
move on?
think cash on cash returns. So you put $1 in, you want to get at least your $1 back. So in venture capital terms, you want to put $1 in and you want to get $10 back. That's typically how it works. But many of the venture capital funds in the country have been historically doing 1-to-1. So I put $1 in, I get $1 back. Maybe I get $2 back.
And it's not just that, right? It's like I put $1 in, I wait 10 years, and then I get $1 back.
Right.
And I can't really touch it.
100%.
Yeah.
So the way that venture capital funds work is you're a 10-year fund plus usually 2 extension years. So think a 12-year fund. Mirror that to our discussion about alignment. Mirror that to the length of time it takes to grow a business and actually take that business to a scale that will generate the return necessary for that venture capital fund manager to return that $1 for $10 back to their limited partners. So there's I'm going to say it this way, there is a misalignment of interest often that is not talked about, that needs to be talked about when that first check goes in. And that is, from a venture capital perspective, we are looking to invest in your company, partner with you, which means we're married for the next 10 years. 15 is around the right time frame these days. Maybe that's going to accelerate because of artificial intelligence and the speed at which new company creation is taking place. But let's just say, for the sake of argument, it's a 15-year term. I'm going to be married to you for the next 15 years, but I know that my limited partners, so my investors, need to get their money back in 7 years or 10 years at the top. So now I have to artificially work with you to say, hey, can you speed up your exit? We need to find you a home. We need to get a good valuation and a good multiple, because I need to return capital back to my investors so that they put more money into my next fund and my next fund and my next fund. So without going into the whole BDC thing, because remember that BDC as a fund of funds investor is also invested in directly and indirectly in many companies in Canada. I think their portfolio is somewhere around 450 companies in the country. Those VC funds that they are also invested in are marking up or down those same companies. So when you do the math, oftentimes, and this was certainly true for me when I was doing fund of funds and direct, we would have to square up whether or not a certain fund we were co-invested with in the same company was giving the same markup or write down to that specific portfolio company. That's what gets everybody all screwy. And that's when all the arguments start to happen. So, I mean, I don't know if that's making any sense to you, but that's sort of how it works. And so if we think about policy and the $750 million bun fight that's happening with respect to early versus late stage, I think the crux of the issue is alignment of interest between entrepreneurs, let's put angels in there too, entrepreneurs, angel investors, venture capital investors through exit, so that there is alignment of interest. And if you're building a company in Canada and you want to go a different route, you want to make it organic or grow it to be $100 million plus, and there's 77 roughly of those in the country right now are at $100 million plus revenue run rate, then you need to be having those conversations at the get-go. And aligning those interests, and we can talk about the policy stuff afterwards. But alignment of interest is going to be, it frankly is everything when you're making investments in this space.
Yeah, Graham, you talked about alignment of interest. Augur VC has not taken government money, and by purpose. Is there a reason why you haven't? And what do you think happens when you do as a VC?
Yes, this is, I think, one of the core issues that you see in Canada right now is this proliferation of government as LP or government as co-investor. So the original idea, like stripping away the name, like, oh, venture capital, like going back to investing 101, buy low, sell high. You look back in history, and the idea of venture investing has been, I'm going to front you money, and if you succeed, I take a cut of it. The basic incentive there is to convert distributions to carry. Now, there's all sorts of other reasons people do it, but like that's the core motive, or it should be, because that aligns incentives. There's management fees as well.
Can I stop you? Explain distribution to carry. Just
sure, yeah. So if a company is successful, if they exit, like Michelle's talking about, the fund will get, its portion of that exit. The LPs get their capital back plus, the remainder of the multiple, less an amount called the carry, which goes to the manager. That's the way you make lots of money in venture capital, is by converting distributions to carry. Yeah, it's your profit, exactly. The issue that you see is that that alignment of incentives can break when government comes along and says, hey, I'd like to be an LP in your fund. Fund manager says, okay, sure. What do you need me to do? Well, instead of trying to just seek profit, I want you to invest in this region, or I want you to invest in this group, or you're only allowed to do deals that look like this. Here's a big long checklist of things you have to show me for every deal that you do. And you have to report on, did you comply not with winning the best allocations that are most likely to profit, but instead on meeting my checklist objectives, because that's my policy goal. I've got some industrial policy. Space is a big one. Defense is a big one right now. You better go invest in those if you want me to keep giving you money. And then the manager says, well, I can take a management fee off of that money, whether I'm successful or not. So, okay, I'll go run around and just do what you want instead of trying to just seek profit at all costs. The problem is that people get addicted to management fees. Tony Fish, who's like a 30-year VC, somebody who I have a lot of time for, he recently wrote that management fees are like heroin. Once you get addicted to them, it's impossible to stop. And so you see these big fund of funds, you see these big funds out east especially, where they've gotten so much money since the early 2010s and even before that out of government, that they've become more of like a grant writing agency in disguise, as opposed to a traditional venture investor seeking to convert distributions into profits. This breaks the mechanism of venture, because it's no longer about making money. It's now about, how can I find a company in like Atlantic Canada that's doing space that has founders that look like this? And if I happen to find one, well, I've got more of an incentive to back them regardless than to determine, is that actually something good to invest in?
Yeah. Derek, feel free to add. Yeah.
Well, first, I just want to violently agree with everything Graham just said. I mean, this was actually one of the points that I put out a couple of weeks ago. And, when I was researching that piece, I realized that there's vanishingly few venture managers in Canada that are ever going to reach their carry. It's less than 10%. It's a tiny number. And so if you think about it, how do the GPs get compensated? They get their rake, they get their 2% of AUM every year, and then in theory they get their carry if they hit a hurdle, which is usually around 8%. Almost none of them will hit 8%. And so once you know you'll never hit 8%, you're just in the business for the rake. And if you're just in the business for the rake, you don't have an incentive to sell anything ever, because if you sell it, your AUM is down and your rake drops. So your incentives are all completely backwards. But I also want to touch on something that Cam said that I very much agree with. And I worry in Canada that we're blurring the lines, because we've got, some years, the VC the government-funded VC is such a huge percentage of the overall capital that's being put into the place that I really wonder if we're blurring the lines between economic development and financial return. And there's absolutely a role to play in government for economic development. I sit on the board of AEC. Our mandate legislatively says it's an economic development organization, and I will argue that it's done, it's checked every box in the 16 years it's been alive. It's done a lot of really good things from an economic development perspective, which is exactly its role.
Which is like job creation.
It's building a VC
creation.
industry. We've got VCs here. We've got, I think it's something like 400 companies. No, it can't be that many. A lot of companies that got investments. There's thousands of people employed in these companies, the outside capital that attracted. From a taxpayer's point of view, it's a win across the board. There is no negative at all. And, all the money that was invested is still there and more. So, it's done its job from from an economic development perspective. And I'm sure when they set it up, I wasn't there in 2009, but they probably expected to get venture type returns. And what they got was venture type returns, but they weren't the 15 to 20% everyone was expecting. They're much more sort of prosaic because that's what the Canadian industry has produced. And so it's fine for certain organizations to say, if that's their mandate, that return is adequate. But if I'm going to invest my own money, I'm not doing it for 5 or 6% that I collect in 15 years, and then I pay capital gains tax on the nominal gain. Like, give me a break. I'll buy RBC and I'll clip the dividend every quarter, right? And pay a lower rate of tax. So, the whole thing is backwards. And what Graham was just saying about once you have entities that say they're venture, but you got to invest in this region, you got to invest in this class of citizen, when there's all these restrictions, it's not venture anymore. And I really worry that's economic development. And I think we've confused the two in this country, and that's why we're on a bad track.
Yeah. Cam, do you want to hop in there? And Cam, I also want to talk about your role at FlightPath, because you guys did, you and Ken Bautista up in Edmonton said, hey, we're going to go to some private capital in Edmonton, raise $500,000 and deploy that. And some of those companies are crushing it, but that was just like private capital that you guys deployed. So I'm curious from your take as having done it from FlightPath VC side to kind of having an outside view, what your perspective is.
Yeah, so I guess maybe two things. One, quick kind of piece on that, because I think AEC, one of the reasons that it's done well is that it said, okay, we're willing to take a little bit less on the return side, but what goes into funds, there isn't restricted funding going into that. You guys are LPs. The only restriction is that you have to have a partner in Alberta. Correct. And there might be a little bit of so you haven't put any money into Alberta, might not, be looking at going into your next fund if there's nothing here, but there's not we're expecting to have all of our dollars deployed here or anything like that.
There's zero direction. You only need a partner on the
here,
ground.
yeah.
And other than that, it's unconstrained. But I don't think I would say that we expect to take less. We expect to get industry returns, beta returns.
Yeah, for sure. And so I think that that is a difference between most programs that you're talking about that go, okay, well, I want this money deployed in Canada, or I want this money deployed in my region. Like, if as much as I love every entrepreneur in Alberta, if I were to start an Alberta fund, your returns would be less than a fund that could invest anywhere in the world. Like, that's just, you're artificially constraining your market, and you're probably going to have lower returns because of it. Right?
I actually don't think that's true. I hear a lot of people say, because we invest in a lot of Alberta companies, and our returns are, we're not knocking the cover off the ball, but they're certainly sufficient for the risk we take. So I actually believe there's investable companies in Alberta. We found a lot of them. I think that it's been tougher recently because the high valuations haven't really reset. But, we actually have quite a few exits under our belt. Why is it that the VCs don't? I think it's because their incentives are all wrong.
So I agree with that. And to be clear, I think there's a lot of incredible deals in Alberta. There isn't, I insulted the room. This is awesome. Off to a great start here.
What we're here for.
Yeah. Somebody need to disagree. No, but anytime you artificially constrain a fund in some way, you're probably going to have worse returns. And so the government coming in as an LP and saying, this is great, we're going to compare you to Fund A that can invest in the best deal it finds anywhere, and you can only invest in my backyard, you're probably going to end up with worse returns, or you're setting up the grounds to have worse returns because of it. And so we kind of, like, as an example, we did that. So we raised a small fund. This is like a decade ago in Edmonton. The whole thesis was, at the time we had started Edmonton, this is great, but like nobody's writing a $25,000, like, just get going, try and see if this works. Here's kind of like enough money to live off ramen and hire a little bit of people for 3 months. Just go. So kind of nobody was writing a check in the city at the time. We felt like that was a blocker. We went to a number of folks in town who either had exited tech or exited something else or made money in real estate or something, and said, hey, we want to do this to try and help grow the community here, and maybe we'll end up making money off of this. But we did say, like, look, if we were able to write a check anywhere in the world, and that was how we deployed this fund, the returns would be higher than just writing checks to just companies we're seeing at just this stage in just this city. And so it was great. Like, we're happy with we've had a couple exits out of the fund. We're like, in the money, so to speak. And we have a number of companies like Drug Bank and Samdesk and Vertical City and other ones that hopefully will exit along the way here. And, kind of hit like that dual piece of being able to, see a return and also, spur some economic activity at the time. But again, like, we were upfront with our LPs about what the risk profile and what the potential returns because of that were going to be. But then at that point, it was just invest in great companies in Edmonton.
Yeah, Michelle.
Can I just jump in for a sec? So practically speaking, there are funds that are regionally focused that do really well. I mean, Intergen, Sandy's at the back. Intergen has done very, very well with their first fund, and Fund 2's en route. So I think it can work at the regional level. It can also work at the Canada level. Where you run into problems is when you do go global and you don't have the people on the boots on the ground in order to be able to figure that out. And one of the issues I think we also have here is our talent pool. I'm going to offend a few VCs, sorry. That's okay, they all know me. We have a talent problem in venture capital. And when we look at Derek and Graham, Cam, a bunch of people in the room, a lot of these folks are entrepreneurs, they're operators, they understand what it means to actually build a business, to manage a P&L, to deal with customers and CS when shit's going sideways. And that's not a policy thing, that's a practical thing that you have to do in order to get the returns that you want in this asset class. And that means you have to be close to your customer, and in venture capital, the customer is you guys, the entrepreneurs. So there's an intrinsic thing that has to happen there. From a policy perspective, if we think about the government dollars that are, I'll say, flooding the market right now, I think the question really is, where is that money going? And is it going into companies? Is it going into funds with the right talent pools that will then be able to deploy that capital and steward it appropriately with the entrepreneurs that can then generate the returns, or not? And I think that's a question that I don't believe anybody's answered yet.
Yeah. Graham.
I just want to build on that. No, I'm just going to dig in. I'm just going to go further. Key point here. I know lots of venture managers in Canada. I'm sure everybody here knows lots of venture managers in Canada. If you're in San Francisco and you have the opportunity to be so lucky to be talking to the founder of a company that's a very hot company, you basically have to make a decision immediately as to whether you want to invest or not. Like, we do the deal in like a day. We've done a deal in like 30 minutes before. The reason for that isn't like, oh, I get excited and so I'm just going to jump on it. The reason is that there's like 50,000 other people trying to get into that deal at the same time as you. You come up here, and one of the things I've noticed is that there's pretty strong skill issues in the venture allocator community in Canada, where one, simply because there's like a shortage of capital, to Derek's point, or at least a shortage of organized capital, they feel like they've got the luxury of treating the founder like, you'd be so lucky as to even get a phone call with me. And I'm sure a lot of you guys, if you're founders out there, you've felt that before, where like you have to chase them as opposed to them coming after you. Number two, probably even worse, there's a belief that there's a luxury of underwriting time where you can take 4 weeks, 6 weeks, 8 weeks, 12 weeks, however long you want. It doesn't really matter, and that it's to the prejudice of the business when you do that, right? So this this difference in norms and pace of play in Canada is one of the biggest issues that I've seen that hurts founders. To your point, it's purely a skill issue. It's because people don't know what they want and they're more concerned about, I want to preserve the management fee gravy train, so I better check all the boxes. That conservativeness ends up turning into a death spiral where you're more conservative, your returns get worse, you get more worried about your LPs leaving you and therefore your management fees leaving, so you become more conservative again. That's one of the biggest issues in venture today, I think.
Yeah, and even if there's not like a formal checklist that you've agreed to when taking some of this like BDC money and money like that, sometimes it's like tacitly agreed, right? Like, oh, these are the funds that BDC is or these are the companies that BDC is investing in. We're the largest direct investor. You should look at these and really consider them and follow us to do due diligence. Yeah. But and so you should only be invested in these, kind of like wink, wink, right? Are you seeing some of that stuff where that's also a reason why people get more conservative?
Yeah, there's a tremendous amount of political influence in venture in Canada as a result of all of the money being derived from political sources to begin with. Policy alignment and industrial policy in particular, which you're seeing right now, people line up against that and they put on branding against it, and they, hire people who have talent sets against whatever industry, defense, rocketry, pick your poison. All of this stuff is to play a game that is not venture capital. It's a game of politics.